The problems that you sort of highlighted for a lot of insurers, this will be existential for them.
And I mentioned this, it already has been for some, but like the macro factors we face in taking risk, I think has changed materially in such a way that our responses to tough years actually don't work anymore. I think a lot of carriers felt that in 2023 is like, here's all the things we do when the going gets tough. Oh, wow, they're not working.
Yeah, the
Yeah.
blueprint
And
doesn't
so,
work anymore. Hi, this is Nick Lamparelli, and this is the future of insurance. Hi, Brian.
hi,
How
I
you doing?
appreciate you coming in. I'm just gonna open the idea of
Mhm.
why we're both wearing green hats right now for those who aren't watching. And then it's over to you. So
Yeah.
I'm putting out another white paper. I do this every now and then, some thoughts that I have on things that I get all worked up about. And I always like to share about it on the show. And I thought this one in particular is right up your alley. You're even quoted in it. And I thought who better to hand the hosting duties over to talk about this with than you. So it's your show today, Nick.
It's my show. So this is Nick Lamparelli, and I am the future of insurance. Thanks, Brian. So you do put out these white papers every so often, right? I know you. I know you're not going to do anything just for the sake of like, I got to pump out some content. To
Yeah,
do something in this regard, which is a significant white paper, it's
that means it's
20,
long.
21 pages, right?
With note, yeah, with end notes, but yeah,
Yeah, but I had to have an AI read it for me. It's
it's
that
very yeah,
long,
yeah,
right? So this when you take on something like this, it means something's irritating you,
yeah.
and you feel like I got to organize my thoughts, get it down on paper, and coordinate a proper response to this problem that I'm seeing.
Yeah.
So for this particular one, which is ensuring the economic viability of our industry, I don't know if that's the exact title of
No,
it.
that's the title. Yeah,
That's
yeah.
okay. So that's the title. What drove you mad? What drove you to do
So,
this?
so I think it's something actually that was driving everybody mad, especially in 2023, and it hasn't really abated. The underlying factors haven't, but it's about profitability and how we go after profitability in this industry. And this goes back to my days running a claims team, where I would look at the cost of my team and the size of the indemnity budget that we were setting up.
Hmm.
And it's really like I was in specialty lines, so you would imagine like expenses matter, but not in the same way that litigation management and indemnity management matter because everything's basically a lawsuit. So there's significantly more money at risk from each of those claims than the cost of handling that claim, even with expensive attorneys involved. Um, it was so blatantly obvious to me that even if I could get rid of my entire team, including me, and take all of our costs down to zero, we're still facing hundreds of millions of dollars in indemnity. It's significant, and yet as an industry, we just keep talking about expenses, and we need to shave expenses. And like I'm an ex management consultant, love lean, love being efficient. I'm not against any of that, but it's last year, 2023, made this so much more blatantly obvious. No matter how great you are at expense management, that's not why any carrier lost money last year. The majority of carriers that lost money, if you wiped out like half of their expense ratio, they're still unprofitable. It's the underwriting. It's not, I'm not saying bad underwriters, it's the underwriting result. It's the losses, it's the risk selection, it's the way we're managing the claims, it's the way we're
The whole
thinking
the
about
whole thing.
exposure, everything. It's
Yeah.
not the expense piece of the puzzle. And so that's been the soapbox that I've been on. I'm lucky that I have access to a lot of data. And so I started to dig into like 10 years of data on premium, on losses, on expenses to try to sort out. I've been saying this, but am I right? What's been happening to the expense ratio? What's been happening to the other component, the underwriting result? And are we chasing expenses without actually getting anywhere? And has the whole game changed? That like the macro factors we face in taking risk, I think has changed materially in such a way that our responses to tough years actually don't work anymore. And that was that I think a lot of carriers felt that in 2023 is like, here's all the things we do when the going gets tough. Oh, wow, they're not working. We're
The
still
game
losing
plan.
money.
Yeah, the
Yeah.
blueprint
And
doesn't
so
work anymore.
yeah, that's like we cut costs. Okay, we've been doing that forever. We've been investing a ton in technology. We've been trimming headcount. There were layoffs last year. All that actually still doesn't matter. We pull out of unprofitable lines and markets. And like that was insurance was front page news a lot last year for states that carriers were pulling out of, turning off new business in. You take your pick. That still didn't matter. And you can't just like pull out of everything because eventually you've painted yourself into a corner and you have nowhere to compete, or your scale is such that like you're not set up to operate at half your current revenue. So like that's a completely different business model you need. That would probably be the end of the carrier. You probably wouldn't survive that kind of shift with the cost base, the fixed costs that you support. And last is like raise rates. Lots of rate taking last year, lots of rate taking this year. And guess what? We're still in a situation where the rate we're taking still not enough. So it's still hard to make money at that rate, and it's too much for people to afford. So you've got a product that's unprofitable to sell at a rate that could be bought, and it's unprofitable to buy at a rate that could be sold. And so then you're getting into a situation, I think, where market clearing is going to be a real issue. And to me, that's just like those are the tools we've used. They're not fit for purpose anymore. And even if they were, they work too slowly to help. Like that rate you took, that's as much as you were allowed to take. But that's not what you actually put in for, which is probably less than what your modeling actually suggested you needed. And you knew the market could bear. So even if you got every single cent, it's still not what you think you need.
In the politics with rate making, right? Like the California problem, if you look into it, the carriers got rate,
Yeah.
but not what the rate that they needed.
Yeah.
And the thing is, they were petrified to ask for the rate that they specifically needed
Right.
because in California it would open it up to one, public consumer
Yeah.
opposition, and two, which is just unbelievable. We're in the wrong business. That the insurance company itself would fund the public opposition
Yeah.
to their own rate making. And so they just kept falling perpetually behind until those significant wildfires at the end
Yeah.
of the prior decade just forced them to ask for 25, 50% rate increases
Yeah.
that were just, create a lot of the scenario that you're talking about. And frankly, might still not be enough for them to
Yeah.
kind of get there. So before we hit record, we were talking about the bureaucratic process. It's essentially driving a car by only looking in the rearview mirror. Walk through the timeline of a rate making process and what that ultimately, like how far behind you
Yeah.
ultimately end up being.
Well, and that's what gets me. And this is actually where you're quoted, and you haven't seen me do it, but I used this clip of you on this show in the past saying exactly this about your book basically eroding out from under you. And it's while you're taking action. So most carriers have some regular cadence to doing product or rate reviews, rate adequacy, rate adjustment, product update kind of meetings. Maybe it's once a year. Maybe if you're lucky, it's quarterly or every 6 months, or you may not do it in every state every year. I mean,
Mm.
carrier that I worked at the start of my career was like, this is the like California, New Hampshire, and Minnesota year. And those were the three for that one product that we could manage in the year because it's a huge effort.
Yeah.
So, you do your annual review, you look at all the data, there's lots of meetings about it, lots of analysis, you come up with the change you need to make. And then the path ahead splits, and there's the regulatory path because you have to file that stuff, and there's the IT path because it's got to get programmed in, and all of these things need to go smoothly. And the states might come back with questions. Some of the states will be pretty instant, or 30 days, or someone file and use. Like I get that. But generally, the states with the most volume and the most issues in the profitability are the ones that are going to take longer. Understandably, that's why they have the heavier regulation, because there's more of an issue afoot. So you're stuck. Maybe it's 18 months after the initial seed of needing to change your rate occurred. If you're lucky, maybe it's 36 months. If the state came back and they're a slower state to respond, it's complex. You could be looking 2, 3 years down the road, maybe more, before you actually get any rate change, let alone the one you thought you needed. And it's like, well, how is that even viable as a business? Like we knew we needed to
Mm.
take that rate years ago. We're just getting it now, which by the way, the world wasn't stagnant. I mean, you look at like COVID, I said this in the paper. There's a top 10 carrier who observed, I think it's a quadrupling of lumber prices in a 6 month period during COVID, which I think everybody who bought anything at like Home Depot
Mm-hmm.
or Lowe's would have observed. Used car prices went up 70% in the same time period. At what point do you file your rate change? And it's like 3 years later. Well, inflation's been pretty bad. So that's why I say like the traditional approaches really are not fit for purpose with the speed with which the dynamics and the macro complications we face continue to change. And by the way, wildfire is not stopping. It's always hailing in like 60% of the country. I've come to that realization. Like
Mm-hmm.
always, the entire kind of like center 2/3 of the country, there's always hail somewhere. And of course, we have a very active Atlantic storm season this year predicted, and so far, it's proven to be that way. So this is a very tough spot to be playing with old approaches that are far too slow and muted to keep up. And Nick, that also doesn't even get into whether taking rate actually, it's not as clean as like you take a 40% rate increase, you get the 40%. No, is you're going to lose some customers. The customers you lose are probably the ones who have alternative options that are more price appropriate for their budget. They're probably better risks because the ones who can't get coverage elsewhere, probably there's a reason for it, but you're keeping them at a higher rate. It's probably not enough now that the dynamics of your book or the demographics have shifted. The loss profile of your book has shifted. So you priced off one book, you're now stuck with a different book that is smaller, is less able to cover your fixed expenses. So that 40% rate increase with this new book scale and profile probably should have been 50, 52, 45, like whatever it was, shouldn't have been 40 because that was a different book of business. And you get in this spiral where it's like, I mean, this is the erosion point that I think you were getting at is every change you make is too late and actually begets more problems.
Yeah.
So this is not fit for purpose. And that's where I just felt like it was June of 2023. I had two meals with heads of claims in one day, and both of them started with like, we're only halfway through the year and we're already deep into reinsurance off of, all of our weather activity, and there hasn't been a single named storm. It's like it was all hail. And I was like, yeah, this is materially broken.
It feel and I've actually written about this, and I have a captive article coming out in ERMI at some point this year where I talk about hard markets and soft markets. And
Yeah.
it's in the past, I think before this digital and technological transformation that has occurred, we'd have cycles, hard
Yep.
market, soft market cycles. I'm not suggesting those are going away, but in my article, I talk about how I think this hard market in particular, has structurally changed parts of the market.
Hmm.
There is admitted business that's going over to the E&S side that will never go back, or
Yeah.
could be decades before it comes back
Something
to
very
the
profound would need to change for it to come back and not just
yes.
waiting for rates to be adequate again.
Exactly.
Yeah.
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 Like the whole appetite thing. And you talk about appetite
Yeah.
in your article, and so if if listen, that's a public this is a public policy problem,
Yeah.
right? Like if you get to a point where there are property owners or just insurance buyers who can't afford insurance,
Yeah.
that's a problem for society, because that's one of the things that we kind of pat ourselves on the back. Society can't run without insurance. Someone's got to
Yeah.
take the risk somewhere, so the marketplace becomes very important. So if that is structurally changed, um, what did you write about in terms of what a new structure might have to look
Yeah.
like for some of these firms?
Yeah. So I think I was trying to end more positively than just like, here's what's everything's terrible. Thank you for reading. I do think there are things we can do. What I would love to see, and actually my episode last week was on the notion of hubris and how many carriers don't seem to fully recognize that they're not quite where they think they are in this journey. There were three major things that I think could form the basis of changing the game. And what I say is, if you're of the mindset that we just need to wait out the soft market and the hard market will come and we'll be fine, which was a strategy, not a good one, but it was a strategy a lot of carriers employed over the past several decades. Um, if you're just waiting till it gets better and you're just going to pull back for a bit until then, what if you had a strategy that allowed you to thrive even when things were tough and lots of others are going away? then it's like, think about how stellarly you'll perform through any cycle. And that's, like talk about Progressive and a couple others that are always seeming to outperform. There's
Hmm.
some reasons for that. So the three things that I touch on are risk selection, which is not just risk selection. How are we choosing the risks that we're going to underwrite? It's understanding them better, using data to get there sooner, so we can be more responsive on the quote side, third-party data, new modeling, et cetera. And the tools are there, but then also thinking about hardening those risks. So, what kind of roofing materials are there? Are there programs that we can work with or put in place to change the nature of the roof so that they are more hail resistant? Are we doing water mitigation and leak detection and all of these sorts of things? What can we do to make the risks better risks, whether we're selecting them or making them selectable? So there's the risk profile piece of it. The second is next gen rating, and this is to the point we were just talking about is how are we taking in information as it's coming and not just once a year when we sit down and print everything out and look at it, but really taking it in an actionable way that is rapid and scalable and moves us to implementing better, more appropriate rates in real time that may have a regulatory implication that we just can't, but we could at least eliminate the kind of upfront actuarial and IT lags. So it's just a regulatory hurdle. And we can look at things like, you mentioned ENS, like can we use not admitted paper in some of these spaces where that's a completely viable path now because the market's so dislocated. So looking at next gen rating is it's more than just the rating tools. It's your ability to go from realization that there's a problem, which you should be able to see in real time if you have the right data and the right data flows, to actually acting on it in as close to real time as possible. And I've got examples in the piece where there's a carrier who went from at best kind of like 4 to 6 months, which I thought actually was quite fast from what I've seen, to they can actually put a small change in within like 2 days. I think it's a week for that thing that would have taken them 6+ months. So that's profound. Um, you think about that lumber price quadrupling in
Hmm.
6 months. So in their like normal big change situation, the price of lumber would have gone up 4x. And now, like as soon as they see it hitting, they can tweak. And they can tweak next week and they can tweak the week after that. Regulatorily, like need to see what's viable there. But then the last one, and this is what really hits me, is I don't think the exposures that most of the mainstream products were created for are the
Hmm.
exposures that they're currently insuring. And I've got a number of conversations around that in here. Um, but if you look at like what is a house, what's it made of, what are the weather factors that it's subject to, what are the public adjusters and plaintiffs bars and all the other things that increase claim costs that are now swirling around it. What's the cost of lumber and labor and all, like a house when the modern homeowners policy was largely developed. It's been tweaked a lot since then, but it sort of came into being in the 1950s and 60s and hasn't materially or like dramatically changed since then. It's iterated a ton. It's very different, but it's still at its core, presuming a house and the exposures around it are largely the same, and they're not. The car, they look about the same as they did in the 50s and 60s. The shape's a little different, but like, they drive back and forth and can turn and whatnot. They are so unbelievably different today.
They're
And that's
computers.
they're like computers and
They're computers
radar
with
towers,
wheels.
and they're so different from what they were. And that's today. Fast forward 10 or 15 years, which is not that far away, they're going to be really different. Like the weight of EVs with the weight of the battery pack is an extremely different thing in an accident than a traditional internal combustion vehicle. And the way that they crumple, like everything is different. And then you factor in like litigation, medical costs. Like medical delivery is completely different, and the costs are completely different than they ever were. So why would our policies work if they were created for what is, other than on the surface, a completely different exposure? And I think we need to get a lot more honest with ourselves about that. And the way that you solve that is not just by stripping coverage out. Like, you can't afford to buy a homeowner's policy in Florida, let's say. Well, you could buy an X-Wind policy. That's great. What in Florida is your major exposure, might I ask?
Wind.
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 So you've still bought a very expensive policy. It's less expensive and it's now maybe entered into the realm of affordability, but it's still very expensive. It just doesn't cover what you actually need coverage from. So what is the point of that? that's not what this industry is here for. And I was talking to someone the other day who really called it out, and she was like, you know, what's going to happen is other forms of capital will come in and solve for it. So I don't like that. Insurance is supposed to be here to create these products and protect. I would love for us to figure out how to do that in an economically viable way for us and for the customers. And if the coverage actually, like the product no longer fits the exposure, we should be rethinking that. And I think there are ways for us to do that.
Yeah. And before we hit record, we talked about the expense, the astronomical expense really compared to other industries of acquiring a customer,
Yeah.
right? And it's in my eyes, like if you're able to get the eyeballs of a customer to come to you, you got to figure out a way to keep them in the door. You cannot let them leave because it was just too expensive for you to get their attention.
Yeah. And that doesn't mean
To
you
to
have to
begin with.
insure them.
Brian, I think if we talk about structurally, I think that's going to cause not panic, but
Discomfort.
discomfort.
Yeah.
Discomfort. And like, let's say you're a county mutual, and I listen, I've been doing a Nikita Khrushchev banging my shoe on the table around this. If you're a county mutual, you don't have to go extinct.
Yeah.
You have assets that are incredibly valuable. You have a balance sheet. You know how to process claims. Like you have an organization. It does not mean that it's got to be your capital. And so whether it's you form an MGA, you partner with an MGA, or you get E&S paper, like this is one of the things that like I've always loved about insurance is that between the London market and Bermuda and reinsurance, there's so many different ways to skin a
Yeah.
cat
Yeah.
here that structurally a mutual should be able to solve this particular problem. But the word you said, discomfort, I think pot stops them, and it's just easier to just continue the business model
For sure.
as
Yeah.
is, and hopefully it becomes someone else's problem
Yeah.
afterwards.
Yeah, well, it definitely will. And part of the problem is the risk and investment of doing that is yours to bear. But given the age profile of our industry, the chance that you're around for the upside of that is smaller. So it's like, well, I have to do all the work. I have to take all the risk. My bonus is going to be cut because we're changing our return on capital to do this or whatever. But whoever replaces me, they'll benefit from my hard work. That might all be subconscious, but that's real. And that's real in any business. That's not just insurance, but I think there are a number of moments that we would face like that. I was at a carrier in a dying space. So the commercial market for med mal it's been shrinking every year. Hospitals are bigger, they self-insure, even doctors' practices are setting up captives. It's like a retirement
Yep.
vehicle for them. Makes a lot of sense. So we had this really well built out and very effective claims organization. So, every couple of years, people be like, well, what about creating a TPA out of our claims organization? Because otherwise it would just, lay people off or let them retire and not replace them and just sort of like fizzle out into nothingness. And immediately, oh, the economics of being a TPA aren't as good as being a carrier. Is like, yeah, that may be. The economics of being a carrier with no market are worse than being a TPA, where there's still a market because someone's got to handle those claims. So we do need to recognize,
Yeah.
you're comparing it to a reality that may not exist. And so maybe we do need to get a little bit more flexible in that thinking. And I had Josh Levine on from Cake and Arrow, and he gave me this phrase of how might we. I think this is a lot of how might we moments. It's like, yeah, you can say no and it's all impossible and the economic whatever, but like, all right, let's just pretend like it's possible.
Yeah.
How might we work with another carrier to meet that need that we just spent all of this time and money to bring that opportunity in? And if we just say no to it, we lose that customer completely, or we turn that agent or broker off from us because we couldn't meet their needs. Whereas if we had a mechanism in place, we could have been the one that solved their problem and continue having an economically fruitful relationship with them. How might we?
Yeah.
And that's sort of the ending note in the whole thing is like, ultimately, like everything I talk about, it's culture in the end. Like it is a mindset. It's a willingness.
Well, how about this as an ending note?
Yeah.
For this particular segment, the problems that you highlighted are societal. So I said it was public policy. There's a lesson here for regulators as well.
Yeah.
Like if the regulator's job is to protect the insurance market and what you say actually comes to fruition, where it's like insurance buyers are unable to afford insurance. So let's take Florida or California, and they're
Yeah,
unable to get a homeowner's policy because of the cat risk. That's a public policy problem.
for sure.
And
Yeah.
and they too need to look at, like, why is it taking us so long? I know California is really beginning to examine this, but I would say we should examine the whole kit and caboodle,
Yeah.
like the whole rate process. And I know it becomes very political, but we're down to public policy, and I think it's incredibly important because the problems that you sort of highlighted, for a lot of insurers, this will be existential for them.
Yeah. Well,
You know?
and I mentioned this, it already has been for some. There's some smaller
Yeah.
mutuals that, because of the hail situation, their reinsurance terms changed in their treaty. And if you're, and I'm not a reinsurance person, so I'm not going to say the right things. It's not your attachment point. Is it like where reinsurance kicks in?
Hmm. Yeah.
Okay, good. All right. So I,
Yeah. Yeah.
I
Good
thought I
job.
knew, but I also thought I didn't know. If your attachment point moves from 10 to $20 million and you're a 40-50 million dollar carrier, small mutual in the Midwest or something, you are going to spend all of that on hail claims next year. I guarantee you that. Like, that movement is 100% going to hit your bottom line. You probably can't afford that.
No.
You couldn't afford the more expensive reinsurance treaty if you could have gotten it, but you can't get it. So now you are just guaranteed to pay that out. And there were at least a couple of very small mutuals in the Midwest that just closed up shop because economically they knew they couldn't write anymore with that kind of structure. So it is happening, but it doesn't have to.
Yeah, and my fear is it's going to accelerate, right? And so and you and I have been kind of hammering this home for years,
Yeah.
but I feel like we've hit an inflection point where we're going to start seeing this accelerate, and it's going to become problematic. And then, and I'm afraid by the time someone realizes we got to take serious action, it might be too late.
Yeah. So Nick, I would leave with a bit of hope that I think most of the people listening to this are of the right mindset, which is awesome. Take that into your place of work, into your carrier, broker, like wherever you are, and try to infect people with that, because there's nothing that I talk about that doesn't exist already. So all of the things I'm like, we can do this, and we can do, like, I can name 10 vendors who have like the rate kind of solutions for assessing the risk, pricing the risk, like all of that. There's already some solutions. I talk about a few of them on the parametric side as a way to buffer some of that stripped out coverage. Could we create new coverage that has a different economic model and therefore different pricing that may not make people whole in the way that an indemnity policy would, but you're talking about it like an indemnity policy is even on the table anymore. So we need to rethink what providing some form of affordable coverage means. Like, these solutions are actually there. So it takes an army of folks like you and me, like the people listening, who are willing to say, like, yeah, we should look at this. And I guarantee you, I've talked to enough carriers to know, like, the talent is there. The conversations are already happening with a lot of those vendors. We need to just question whether the time that we're taking is necessary, or is there a way for us to push harder, faster, smarter, because the upside is there. And unfortunately, the downside is pretty dark. So it's worth that effort. And I think this is a time when we can do that, because the economics, the results really reinforce, like, no, this isn't just some people being scared. Like, this is 2023 was very real. The industry only made money at the end of the year because of investment returns. So like, from an underwriting standpoint, it really is tough. Now is the time to actually push this stuff into action. And I think we really can.
And there's the hope. So, Bryan, thanks for coming on to your show.
Thank me for having me. Thank you for coming in and guest hosting. I really appreciate it. And for letting me quote you yet again in this paper. I don't know if you realized when you said your point about like the business eroding out from under you, just how perfect it was, but it was awesome.
I mean, I say these things, and like you said, you and I are not preaching something that has not been done before. So this isn't like, some, new sort of technology. This has been done before.
Yeah.
So when I say it, I'm sure that there is a little bit of discomfort and people aren't going to take it seriously, but I hope they will now that they listen to this.
Yeah. Well, it's awesome. Nick, thank you for helping me do this. I do want to point out, if people want to get this report, it's free. Like, like totally free. It is available at future-of-insurance.com/profit.
It'll
Because
be in the
that's what
show notes.
it'll be in the show notes too. It'll be linked up there. And yeah, you can download it. I'm also going to put it on the Kindle store, and you can even get it in Audible with a lovely AI voice reading it. Those ways aren't free, but the PDF's totally free. So yeah, available. And I hope that people read it and share it around, because that's how we get this stuff to move.
Awesome. Thanks, Bryan.
Thanks, Nick.